Hi, this is Zach Meir, editor of Spreadbet magazine, with a look at the major currency crosses in the wake of the latest revelations regarding sterling and regarding the euro. As we can see from sterling, you don't have to be Mark Carney to work out that the market thinks there's going to be a rate rise sooner or later, or at least thought there was going to be a rate rise sooner than later. That was indicated by the bear trap below $1.50 in July, and since then it's been uphill all the way. And it looks as though it's going to continue like that, given the way that we have hints today that the rate rise that everyone's expecting could happen as soon as February next year. On a technical basis, we've got a rising trend channel from June. Floor of the channel's currently around $1.63, and really, while there's no end of day close back below the 50-day moving average at $1.6422, you'd expect this market to do what it did towards the end of this week, which is head higher in a near vertical fashion. The favored destination over the next 1 to 2 months is $1.70. We've had plenty of false alarms in terms of hitting the upside here, but I think the bear trap we've had below $1.64 over the last few days could be the right trigger here for a $1.70 handle on this cross. You've also got that extended RSI support line running through the 40 level, which also underpins the price action. Moving on to euro dollar, and here we've got a situation the other way, really, with the ECB hinting that it's looking at ways of delivering a negative interest rates as opposed to the 0.25% that we've got at the moment. We've just got a failure at the 50-day moving average at $1.3650 this week, and we're threatening to go back to the floor of a rising July price channel at $1.35. No breakdown yet, and presumably we could still head to the upside, but the way things are, you've got to favour at least a test of $1.35 over the near term, especially given the way that we've had two near-term failures at the December RSI resistance line at neutral 50, and that's going to pressure the price action over the near term. So probably the favoured scenario here is towards $1.35, possibly down to the 200-day moving average at $1.3394, but not yet the big breakdown that the doomsters are looking for. Finishing off with dollar yen, and here we have a sort of a let-off for the bulls of the yen, in the sense that the rebound at the beginning of February came off former September resistance, and we didn't go below the 100 yen level, which would have been psychologically quite damaging. Rising trend channel, obviously, here from July, and really the next buy trigger would be a break of the 20-day moving average shown here in grey at 102.76. We need an end of day close above that to deliver a fresh leg to the upside. Also back above RSI 50 versus RSI 47 at the moment is required. So an intermediate rally on the way, but we're on hold here, waiting for fresh momentum to pick up over and above the turnaround above the 200-day moving average. Upside 106, 107 by the end of March if everything goes according to plan. That's it from me. See you again next time.